Welcome back, dear students and scholars. We are continuing ASC 326, and this video focuses on available for sale debt securities. This is an important shift from the CECL model in ASC 326 20. Available for sale debt securities follow ASC 326 30, which has its own credit loss model, its own allowance cap, and its own split between earnings and OCI. Today, our job is to keep those roots separate and clean. Let us locate where we are in the series. Video 1 introduced the CECL framework and scope. Video 2 explained measurement for amortized cost assets such as loans and held to maturity debt securities. Video 3 handled PCD assets, commitments, and collateral. Now, video 4 separates available for sale debt securities from the amortized cost model. The key principle is simple: classification drives the credit loss model. If the security is available for sale, do not force it into the ASC 326 20 CECL engine. Let's look at the learning path. First, we identify which securities fall within ASC 326 30. Then we test whether a credit loss exists by comparing the present value of expected cash flows with amortized cost. After that, we check the intent to sell gate because that can change the entire accounting route. Then we split a decline between the credit portion in earnings and the non-credit portion in OCI. Finally, we solve the Harbor Grid Fund example and practice the model through an MCQ. Available for sale debt securities are separate because they are measured at fair value, not amortized cost. ASC 326 20 applies to amortized cost instruments, including loans, receivables, and held to maturity debt securities. ASC 326 30 applies specifically to available for sale debt securities. The same broad topic is credit risk, but the measurement route is different. A helpful memory line is this: same credit risk family, different accounting address. Sending AFS securities to the wrong address is how the accounting mail gets lost. ASC 326 30 is narrow and classification specific. The security must be classified as available for sale under ASC 320, and unrealized gains and losses generally flow through other comprehensive income or OCI. Certain loans that meet the definition of debt securities can also enter this model when classified as AFS. The assessment is performed at the individual security level, not on a pooled basis. Common equity securities do not enter this model because equity securities follow separate guidance under ASC 321. When fair value is below amortized cost, we do not automatically record a credit loss. The route starts by comparing fair value with amortized cost. Then we estimate expected cash flows and compare their present value with amortized cost. Next, we check whether the entity intends to sell or is more likely than not required to sell before recovery. Only after those gates do we allocate the decline between credit and non credit components. The model is structured because market prices can move for many reasons, and not every price decline is a credit event. The credit loss test asks whether the present value of expected cash flows is below amortized cost basis. The entity estimates the cash flows it actually expects to receive, not merely the contractual cash flows printed on the instrument. Then those expected cash flows are discounted using the security's effective interest rate. If the present value is less than amortized cost, a credit loss exists, subject to the fair value cap. This test is about expected collection, not simply about market price movement. Before performing the credit versus non credit split, we must pass through the intent to sell gate. If the entity intends to sell the security before recovery, or if it is more likely than not required to sell before recovery, then the security is written down directly to fair value. The full decline goes to earnings, no allowance is established, and no OCI component remains. This is a major exam trap. If the intent to sell gate is triggered, do not continue running the normal allowance split. The route has already changed. If the intent to sell gate is not triggered, the total fair value decline may have two destinations. The credit portion equals amortized cost minus the present value of expected cash flows, and that amount goes through credit loss expense with an allowance. The non credit portion is the remaining fair value decline after removing the credit portion, and it goes to OCI. The security continues to be measured at fair value. Earnings captures credit deterioration, while OCI captures non credit fair value movement such as interest rate or liquidity effects. Now we add the allowance cap. The credit loss allowance cannot exceed the fair value shortfall, which is amortized cost minus fair value. First, calculate the credit loss using expected cash flows. Then, calculate the total fair value shortfall. The recorded allowance is limited to the lower of those amounts. The reason is economic. If the security can be sold at fair value, recognizing an allowance beyond the fair value shortfall would overstate the loss. The cap is like a ceiling. In accounting, we like ceilings when they prevent overstatement, but not when they hide evidence. Let us apply the model using Harbor Grid Fund in 2028. The available for sale bond has an amortized cost basis of $100,000, fair value of $92,000, and present value of expected cash flows of $96,000. The entity does not intend to sell before recovery and is not required to sell before recovery. Our task is to confirm that the intent to sell gate is not triggered, compute the credit loss, check the allowance cap, and determine the non-credit OCI component. The total fair value decline is 100,000 minus 92,000, which equals $8,000. The credit loss from the cash flow test is 100,000 minus 96,000, which equals $4,000. The fair value shortfall cap is $8,000. Since the $4,000 credit loss is below the $8,000 cap, the cap is not binding. The remaining non-credit OCI component is 8,000 minus 4,000, which equals $4,000. So the allowance is $4,000 and the non-credit decline in OCI is also $4,000. The journal entry view separates the two components. For the credit loss portion, the entry is debit credit loss expense for $4,000 and credit allowance for credit losses for $4,000. That part affects earnings. For the non-credit portion, the entry is debit other comprehensive income for $4,000 and credit AFS fair value adjustment for $4,000. That part does not go through the income statement. The available for sale debt security is still presented at fair value of $92,000, while the allowance is shown as a separate contra asset. The allowance is updated when credit expectations improve. If expected cash flows improve after an allowance has been recognized, the entity reduces the allowance and records the reversal through credit loss expense. But the allowance cannot go below zero. We are correcting a credit estimate, not creating a bonus gain because management feels cheerful. Once the allowance reaches zero, further improvement in credit expectations does not create a negative allowance. The model allows reversal, but only up to the amount of the existing allowance. ASC 326-30 also includes policy elections that affect mechanics. An entity may exclude accrued interest receivable from both fair value and amortized cost in the credit loss test. If the entity writes off uncollectible accrued interest in a timely manner, it may avoid measuring a separate allowance on that accrued interest. The entity may also elect to adjust the effective interest rate for expected prepayment timing. These elections are applied consistently by major security type such as corporate bonds or mortgage-backed securities. Consistency is what turns a choice into a policy. Purchased available for sale debt securities can also have credit deterioration at acquisition. If the security has significant credit deterioration when purchased, it may qualify as purchased credit deteriorated under ASC 326-30. The allowance is measured at the individual security level at acquisition. This is not pooled with amortized cost CECL assets under Dash 20. The concept connects to the PCD discussion from video 3, but here the security remains inside the available for sale fair value framework. The impairment analysis must be supported by evidence. Factors include the extent of fair value decline, adverse industry or geography, payment structure, missed principal or interest, rating changes, issuer financial condition, expected defaults, collateral, and credit enhancements. No single factor automatically decides the answer. Even the length of time in an unrealized loss position is not enough by itself. A security can be underwater for a long time, but the entity still needs a documented cash flow and credit analysis. Time alone is not the accountant's crystal ball. Here are the common available for sale traps. First, do not apply ASC 326-20 CECL directly to AFS debt securities. Second, do not treat every fair value decline as a credit loss. Third, do not ignore the intent to sell gate because it can bypass the allowance and OCI split entirely. Fourth, do not forget the fair value shortfall cap. Fifth, do not send the non-credit portion to earnings. The market price can be a noisy neighbor, but only credit deterioration belongs in credit loss expense. Now choose your answer. An available for sale debt security has amortized cost of $100,000, fair value of $92,000, and present value of expected cash flows of $96,000. The entity does not intend to sell and is not required to sell before recovery. What credit loss allowance is recorded under ASC 326-30? Work through the decision sequence. Check the intent to sell gate, apply the cash flow test, verify the allowance cap, and then lock your answer. The correct answer is B, $4,000. The intent to sell gate is not triggered. The credit loss equals amortized cost of $100,000 minus the present value of expected cash flows of $96,000, giving $4,000. The fair value shortfall is $8,000, so the cap is not binding. Option A is wrong because a credit loss exists. Option C is wrong because $8,000 is the total fair value decline, not the credit portion. Option D is wrong because $96,000 is an input, not the allowance. If this lesson helped you, please like the video, subscribe to the channel, support the course, and share it with colleagues learning US GAAP. In video 5, we will bring ASC 326-20 and -30 together through practice cases, disclosures, and comparison bridges.